Reversal patterns. There are three primary reversal patterns that we're going to look at, and we're going to look at the technical components and price behaviors that present themselves in these reversal patterns so that we can pick up on them early in order to really get an optimal trade and optimize the shift in market sentiment as presented by these patterns. One, of course, is the head and shoulders patterns. The other is what I call the bull-bear battle, where it gets very choppy and erratic. And of course, we have the false break pattern. And these various patterns can be observed on all time frames. The higher the time frame, the more powerful, but once again, you need to have skill in refining your entry position. And but the potential move on the larger time frames can be considerable. The first one we're going to look at is the head and shoulders. We're going to look at the head and shoulders top and the head and shoulders bottom. And for those of you who this is new to, quite clearly, this formation looks like a head and a shoulders formation, this being the left shoulder, the head, and the right shoulder. And if you see in my charts, you see LS and RS. That simply means left shoulder and right shoulder. The head and shoulders top is a bearish formation, suggesting that price will start to trend down. The head and shoulders bottom forms a base, suggesting that the next trend is going to be up. Head and shoulders considerations, they can be found in all time frames. The market should have a very clearly definable trend, either up or down. We look for the market to break the short-term trend line, trailing the market. Price should return to the last base of support or resistance, then look for the right shoulder to form. Once price has returned to the last level of support or resistance, look for the market to make another attempt or new high or low to form the right shoulder. Then we're going to ideally try to find our entry point at the tip of the right shoulder using all of our tools: fibs, backside of a trend line, support, resistance, pivot points, etc. We're going to look for a convergence of factors at the right shoulder. Ultimately, you're still going to have to make a decision on the entry, and there is no way that I can express any absolute rule to enter on the tip of the right shoulder. But what we're going to do is we're going to work through a variety of scenarios and some price behaviors that you want to consider while making your decision to enter a trade. Now, these points that I've noted here, we are now going to go through the visuals. It's very difficult to understand what's being said here until we walk through the visuals. But once we walk through the visuals, then you can come back to this slide, refer to it in your book when you start to interact with the market. A basic anatomy of a head and shoulders top formation will look like this. We will see price trending up, and as price trends up, we are going to trail it with what's called a short-term trend line. See your section on trend lines. The short-term trend lines will typically connect the last two reasonable low points of the trend and extend into the future. Once price breaks through the short-term trend line, we start to look for a potential reversal formation. Certainly there may be another trade opportunity in here, but this is all other trades aside. Once it breaks through the trend line, we then look for price to come to, it is ideal if it comes equal to the last level of support or lower. The lower it goes, the better. The more probability of a reversal increases. The third step is we then watch for the right shoulder to form. Now, once step 2 has been established, we then look for technical considerations within this leg from the head. Okay? we're looking for technical considerations and parameters. So once this low forms, we would do a few things. We would have our pivot points on an intraday basis drawn to see where we are relative to this potential up leg. We would pull our Fibonacci tool from the head down to the base low to see where our retracement levels lie. Within this swing down, we may see distinct levels of support and resistance that may line up with Fibonacci's and pivots and backside of the trend line. And what we're looking for is we're looking for the most idyllic level of support and resistance or convergence somewhere within this range. And it can occur anywhere between the 38% retracement and the 79% retracement. And it's between those two levels that we're looking for an ideal point of convergence where price may spike or come and meet resistance. Then ideally we want to make the trade somewhere in this area in anticipation of a leg down, being the second leg down, which is typically the strongest. Now, when we're considering making a trade at the tip of the right shoulder, one of the factors that we want to consider is that we have enough distance before we reach the next base of support to take some profit in the move from here to here, because price may simply come down to the base level of support and continue to bounce around for a while before moving down, or it can continue moving sideways, or it can go up. There is kind of a general rule, like in the equities markets and with some of the other instruments, where traders like to wait for the break of the neckline and trade the break of the neckline, which you can maybe do it on the larger time frames like the daily chart if you're looking at a position trade. But I would be very hesitant to trade the break of the neckline because we start to see a lot of volatility. And one of the characteristics is that price will often come back, test the base of the neckline before continuing to fall. I am just much more comfortable getting in up at the tip of the right shoulder. So here we have a list of the steps 1 through 5 when considering your head and shoulders trade. A couple points to note. No two head and shoulders formations will be the same ever. They'll always form differently. Nor will they come to fruition or completion in the same manner of price action. That's just the way trading works. When the head and shoulders formation is more visually symmetrical, it tends to have a higher probability of coming to fruition in a more predictable manner, and a higher probability of it coming to completion or putting money into your account. The neckline is often angular, but once it's broken, we often will see that price will come back and test the backside of the neckline, regardless of its angle. Look for the left shoulder to equal the right shoulder. That often offers a ideal entry point, technical entry point. Look to see if your Fibonacci's backside of the trend line, support and resistance pivots, line up with the left shoulder. Following the trend line break, when the neckline forms, the further the market moves below the neckline or the previous level of support before forming the right shoulder, then the market has a higher probability of reversing. So the deeper that base, the higher the probability of reversing. I pointed it out in the last slide, but I'm going to point it out again when we see some examples. Again, these head and shoulders will come in all shapes and sizes on all time frames. It's more about price, of what's happening behind the scenes with price. It's more a reflection of the trader's atmosphere and how the market formed a high, and then the right shoulder is simply the market's second attempt where the late comers still think that price is going to push higher, but there's just simply too much selling pressure in a head and shoulders top situation, just too much selling pressure, and the right shoulder is actually your opportunity to get in short rather than joining the exuberance of the longs. The larger the time frames, the higher the probability, and the bigger the moves associated with the larger time frames. A head and shoulder formation on the right shoulder contains even more power and higher probability. What I mean by this is that when the right shoulder is forming, if you have a larger time frame, and if the right shoulder is forming, and if you see on that right shoulder a little miniature head and shoulders, then there's a higher probability that that right shoulder is really going to motor. And we'll see some examples of that. So I realize it's tough just to read it, but you've got the visuals in your book, and you can flip back and forth when we start to see some examples. Just walking through a head and shoulders top formation, we have a trend that is established, and we're just trailing the trend by connecting our last two lows with a short-term trend line. Then we see price break through the trend line, and what is the next step? Once price breaks through the trend line, then we look for price to come down to the last level of support. Once it comes down to the last level of support, then we start thinking head and shoulders potential reversal. And at this point, we will begin to implement our tools and place them on the charts: pivots, Fibonacci, support, resistance, etc. We now have our neckline in place, and then we look for the right shoulder to form. Here the right shoulder equals the left shoulder, which is one of the technical considerations when looking for your entry. And then now price moves below the neckline, comes back and retests the neckline. And moves downwards. Now, another point that I want to make is once you see a head and shoulders formation come to fruition, or looks as though it's coming to fruition, then we're now at the most explosive and most powerful point of a new trend. And if let's say you're not participating in the head and shoulders pattern, and you're making an interim day trade, then you want to trade in the direction of the head and shoulders pattern that has presented itself on one of the higher time frames. So some considerations when looking for your entry on the right shoulder are pivot levels, fibs, backside of trend line, equal left shoulder, support, resistance levels, or anything else that may line up at this point. Let's add MACD now. Price is making higher highs. MACD is diverging. Now we see a trend line break, and so the divergence pays. But once we see this level of support form, the divergence is simply one more consideration suggesting that this reversal may come to fruition. So again, once you see divergence and price has come to its last low, then you start to look for that right shoulder to form. And here are our steps. 1, the break of the trend line. 2, price comes back to the last level of support. 3, look for the right shoulder to form at one of our technical levels. 4, a break through the neckline. And 5, the retest of the neckline. Reviewing the steps to making a head and shoulders top trade. a break of a short, medium, or long-term trend line. Typically it's a short-term trend line. Price falls to the last level of support. MACD has diverged at the high that may form the head of the Head and Shoulders. Watch for the right shoulder to form as the market makes another attempt at a new high. Mark the price level of the left shoulder and watch for the possibility of the right shoulder to turn at that level. Use it as one of your technical components. Mark your pivot levels to help you find an entry. Look for a convergence of a pivot level at the price level of the left shoulder for a higher probability entry, or simply include your support resistance and your fibs as well. Ultimately, I like Fibonacci. Remember to keep an eye on the backside of the trend line that has been broken, and that could offer a distinct level of resistance. That's one of your more profound levels of resistance, by the way. However, it doesn't happen that often, but when it does, it's important indeed. Also look for the backside of that trend line to converge with one of your other technical factors.